Many traders seem to want in on readily analyzed and properly packaged trades. Nothing wrong with that, we all want advice from the best, but to blindly follow any technical analysis conclusions on YouTube can easily turn into a dangerous business. I don't know about you, but when I started out trading myself, I would pay close attention to the technical analysis on YouTube made by professional traders. I then tried to piggyback on their analysis with the hope of getting something for free. Money for free, that is, until I realized that it doesn't work. Now, not only did I start this channel to teach you technical analysis, trading and market psychology, I also started it to help you dodge all the vicious market bullets that mercilessly kill unassuming traders, whether novices or seasoned pros. Mistakes that can easily lead to nosebleed losses. And mistakes that made me wish this channel was around to straighten out all of my question marks instead of learning the craft of trading the immensely pricey way. In this episode, we'll discuss 3 important points on how you should approach technical analysis videos on YouTube for full value, and why blindly copying them often ends up a costly endeavor. For they are valuable indeed, but only if watched in the right way. This of course assumes that the technical traders behind those analyses know what they are talking about to begin with, for you must always look out for false prophets. There are one too many out there. But given that the technical analysts are profitable and serious, these pointers will equip you to extract full value from any serious YouTube technical analysis. But before we get started, if you like this channel and want to see more episodes, please like and subscribe. Now, let's begin. 1. Technical analysis is not about being right, it's about making money. First of all, technical traders are no wizards. We possess no magical powers to see into the future. In fact, most traders, even great ones, are wrong more often than they are right. This pisses people off who erroneously turn to technicians for resolute market directions. But the skeptics have gotten it all wrong, for they don't understand the game to begin with. One key thing that separates great traders from the rest is that the great ones let go of their losing trades immediately upon realizing it's going the wrong way. When they find what they're looking for, on the other hand, then they stick with the trade and milk it. Trading, for example, has many similarities to poker and sports betting. One prime common denominator is that you look for good risk to reward spots, odds that for some reason are bent in your favor, such as when your opponent moves in on you pre-flop and you wake up with pocket aces. No matter what your opponent has, except for pocket aces too, you stand at least roughly an 80% chance of winning. Hence, you stand a great chance of winning despite having been dealt those aces by mere chance. And if you ever see a bookmaker offering 2-to-1 for your money for Brazil to beat San Marino in football, you might do wise in mortgaging your house and bet it all on the samba dancing caipirinha connoisseurs. And the latter you may take as financial advice. In poker, the most steady winners are not necessarily the ones who win the most pots. No, for the object in poker is not at all about winning the most pots, it's about winning the most money. And the exact same principle applies to trading too. Some of the most successful technical traders in the world are right just about 30 to 35% of the time. They lose a lot of small trades, but when they win, they more than compensate for the losses. Much more. Or as George Soros once put it, my approach works not by making valid predictions, but by allowing me to correct false ones. The greatest traders I know have one particular thing in common. They all quickly abandon a trade once they realize they're in the wrong. No ego, just small losses. When they're correct, however, they let their winners ride. For in the end, technical trading is nothing else but identifying good spots that will pay off well whenever you are right, and that will let you off the hook cheaply whenever you are wrong. So whenever you watch a technical analysis video, your focus should be on making money, not about being right. Like getting paid 10 times your investment whenever you roll a 6. You'll certainly be wrong most of the time and you can by no means control the outcome, yet you can safely begin to look for that summer home in Monaco. 2. By the time you shadow a trade, the trader themselves may have changed their mind already. Just because a trader says they are looking at entering such and such trades at this or that level doesn't mean that they actually will. Now, don't get me wrong, if they say they intend to, they will still look to do so, given that they're honest, of course. But as mentioned in the Great Traders versus Bad Traders episode, the best traders I know change their mind all the time. And so do I, for whenever new data surfaces on the charts, any professional trader can and might very well make a 180-degree turn. The renowned trader Alex Grazerman once said that if you have the kind of investment IQ where you think you know everything, you'll end up failing. And those are wise words, for making up your mind and sticking with it is toxic behavior on the trading arena. One that will quickly land you in the poorhouse. But the danger in this is that few YouTube analysts follow up on their trades, at least not immediately or fast enough. This isn't necessarily because of nonchalance, but rather because the markets can develop faster than anyone can produce episodes. So, whenever you watch a technical analysis video, you must be fully aware that the trader may have found new data that disqualify the very trade you yourself were looking at taking. And they may not necessarily alert you about it. 3. Watching a technical analysis video should give you a helicopter perspective, but it is your job to bring out your microscope. In the Record Week Market and Grand Shorting Opportunity Ahead episode, we discussed at length a potentially juicy shorting opportunity, one in which I talked about going short if and when the price retested the EMA 200 for the 6th time on the daily chart, something that indeed took place. But rather than being rejected, the price continued upwards. Someone asked me in the comments section if my trade was an expensive one, and the same question was asked when I talked about shorting Swedbank. But they weren't expensive, for I had yet not taken them. Here's the thing, and this is important, so listen carefully. When a technical trader presents prospect trading opportunities such as shorting Swedbank, this short is certainly in play and based on the bigger picture findings on the daily and weekly charts. But it's not on the daily and weekly charts that you find the ideal entry spots. For you don't just hop into a trade, you want to get an optimal price. For every decent trader is in fact in the bargaining business where they will fight to death for any extra gain or saving. Those savings may not sound much, but minor price adjustments can have a big impact on your risk-to-reward ratio and quickly skew a good trade into a bad one. If you're looking at going long an equity that costs 1,000 euros, 1,000 euro equity? Are you dealing blood diamonds? If you're looking at going long an equity that costs 1,000 euros and your technical stop loss is set at 990 and your technical target is set at 1,030, then you have a 3-to-1 spot. You risk 10 when you lose, but win 30 when you win. In such case, you only need to be right 25% of the time to go break even. If, however, you manage to buy a temporary dip at 995 and your technical target remains, then all of a sudden your risk-to-reward ratio is 7-to-1. You risk 5 but stand to win 35. Now, what's my point with all this drivel? Wouldn't it simply be due to luck if the price were to dip down to 995? And wouldn't you risk missing out on a good trading opportunity by waiting and risking to miss the entire ride? No. My point is that the daily and weekly charts give you the overall picture of mathematically interesting trades. They tell you that once the price is around 1,000, you should be looking for a nice entry. But it is on the lower timeframes that you can squeeze water out of a rock and get the truly attractive prices. Personally, I like to use the hourly chart for precise day and swing entries. In the case of the EMA 200 touch and Swedbank, they both looked way too strong on the hourly. So I decided to wait. So, what happened then? Instead of immediately shorting Swedbank at the bottom of the triangle as proposed, or the EMA 200 on OMXS30, I waited until the hourly began to show some real and consistent weakness, which is one of the many reasons why traders use different time frames. In this case, I got much better entry prices than I would if I'd only stuck with the daily and weekly charts. For just like you don't cut your toenails with a chainsaw, neither should you look for entry spots on the bigger time frames. And when you watch a technical analysis that is based primarily on the daily or weekly charts, it will be nearly impossible for the analyst to tell when the precise entry spot will arise on the hourly. or lower time frames. So, whenever you watch a technical analysis video, it should be approached from a helicopter perspective. It is your job to properly land a trade by bringing out your microscope to find an ideal entry spot. Let's sum it all up. So, whenever you watch a technical analysis video, your focus should be on making money and not about obsessing about every analysis being right. You must be fully aware that the trader may have found new data that disqualified the very trade they themselves were looking at taking and without notifying you. You should approach their analysis from a helicopter perspective, for it's your job to properly land a trade and to bring out your lower time frame microscope for an ideal entry spot. Or simply put, use technical analysis videos to learn and improve on your own game and to get perspective on your own analysis. For you always miss things when you do an analysis yourself, however minor, whether it is because you miss obvious signals or because you accidentally put too much focus on the wrong things. For that reason, by listening to the advice and analysis of other traders, good traders, it allows you to see more of the bigger picture and helps you fill any technical knowledge gaps. Feel free to use the foundation of their analysis, but you must always do the finish yourself, for we are all responsible for our own trades. That was all for now. Thank you and goodbye.